Welcome to the Mortgage Broker Podcast, tailor-made for Canadian mortgage industry professionals. Proudly presented by A Better Way Mortgage Group, this podcast is your trusted source for insider insights, market updates, and strategies to elevate your career in the ever-evolving world of mortgage brokering. Whether you're a seasoned broker with A Better Way Mortgage Group or an industry enthusiast looking to stay ahead, our episodes are designed to empower you with the knowledge and tools you need to excel in the Canadian mortgage space. So maybe let's move on to just some market trends and insights. Is there any key trends that you're seeing in Canadian housing or borrowers in general that's maybe shaping the alternative mortgage landscape?
Absolutely. Let's start with probably the biggest change in 2025 was OSFI implementing LTI, right? That has affected most of us lenders, and it took a while for us to figure it out. And basically all that is it's the leverage that a client can have with the borrowing power. So we can only have a certain amount of units to push on that LTI. From there, our first 3 months was a challenge. So we had to figure out how to bring in the files that will, I guess, keep us compliant. And that was a trick. So that's one thing. But other trends, so let's go back to the trends. What am I seeing? So I will say this with caution, because if you're a homeowner, you're going to panic, but don't panic. We've seen values come down. But you know what? If you take me back, has it been 5 years, COVID? If you had told me that homes would go up 30% a year over year for 3 years, I would tell you you're crazy. They weren't supposed to.
Yeah.
But we were near zero rates, and so everybody bought, and people overpaid. And people overpaid because they were afraid that they were going to lose out. Mm-hmm. So now you fast forward to normal times. And what's happened is we have seen values come down a little bit, no doubt. And I think most of the falling has come. But I wouldn't panic too much. It really is right sizing. And hopefully you didn't get bitten during this time. But if you haven't and you're looking to buy, I think it's stabilized. And that would give me a good cause to say, yeah, it is still a good time to buy. The reality is we're still very short of properties nationally, right? Nationally. BC and Ontario are probably the worst. And actually, from a depreciation level, BC and Ontario, less than 1%, we have come down the most. So that is all that it is. It's 1%. Hopefully it's not your house, but it is 1%. So that is one thing. Affordability continues to decline. We see that. The Bank of Canada is helping us with dropping the values, and that 1% correction is going to help. People are using other sources. Maybe once upon a time, just your normal job is going to help. Now, everyone's got a side. Everyone's got a side job, and it's necessary. And so that's why we come with a 35-year M, and we come with our contributory income. These things help. And most lenders now will go to 60-60, or sorry, on the alt side, forgive me. So that is very impactful to our business. Other trends that we see, it really is the last minute things on a file, the surprises. I think as an industry, you've been around long enough like I have. It used to be that a client was okay with getting the approval back within a week. Well, it went from a week to 4 days to 3 days to 2 hours, right? What this means is everything is being turned over faster and faster, including the mortgage agent that collects the documents and sometimes doesn't screen what they're getting. So my advice is the same for the last 25 years is look at the documents. Firstly, you need to know, what is the lender going to ask? We talked about that $50,000 deposit. Well, we have to source it. And so most of the delays and escalations happen because something happens near close where the bank statements or whatever other document tells us we need to go get more details. And that could delay a closing. So we have seen delayed closings. And that is, I think, partially because we are rushing the process and partially because we are not looking at the documents with the scrutiny that we used to.
Yeah, that's a good point. It just makes me think of just general borrower behavior and some of the shifts that we've seen, more so from like an affordability perspective. You know, you've mentioned some of these other, avenues like contributory income, different things like that. Have you seen any shifts in the borrower behavior more so from like, say, self-employed clients or credit challenge clients? Because the reason I say credit challenge is I found the average credit score, even with the private lenders, is like way higher than I would have ever expected. And, when I first came into the industry, I focused on private lending, alternative files, self-employed clients. That's pretty much all me and Derek did for the first 10 years of our career. And it was very common to see a 500 beacon score. And it's not really the case anymore.
It's not. No, that's a really good point. So I can't pinpoint why credit is better. I think probably the consumer knowledge. I think we've done a really good job, as an industry to tell people to be good on your credit, because every consumer is going to be hit, whether it's buying a house or whether it's going and getting a car loan. You'd rather pay 1% versus 5%. So I think we're all educated that way. But from a lender, and I saw this at Optimum as well. So at ING Direct, it made sense that I saw a lot of 700 beacon scores, 680. We were a conservative A lender. 10 and a half years ago, I started at Optimum, and I saw a lot of what you're talking about, the damaged credit, the 500, 550s, sub 600. Yeah. And then the BFS programs, I think, changed that a lot. So percentage-wise, it's a large share of our portfolio, but they don't qualify at your traditional bank. Reason being the write-offs. We use a bank statement program rather than an NOA program. The NOA shows you the net, doesn't show you the gross ups, doesn't show you the write-offs. So our program is much better for your client. And I would tell you, one of the things that I think is so important is taking a few minutes and going onto the CRA and showing your BFS clients what it means to claim $100,000 on your NOA versus claiming 50 and then paying the taxes on the 50 versus the 100. That will convince them to take an Alt-A mortgage.
Absolutely.
Because if you're paying 50% taxes, that's a $25,000 hit on taxes versus 1% on your mortgage that ends up being maybe $5,000, $6,000 depending on the mortgage. So if you can do that math, as an agent, take your clients through that journey, you will have a much easier time selling a 5% mortgage versus a 3% mortgage at your traditional A. But that also means that a BFS client that is doing well knows how to handle their credit. Totally. And so I don't remember our average off the top of my head. I can tell you it's in the 680 range, which is not common for an alt lender 10 years ago.
100%. And I've seen the shift in self-employed borrowers where in the early days of like, hey, Optimum, RFA, Equitable, whatever it is, that's going to be your option today because of the way your, taxes are and whatever you've done from a business structure perspective. We'd always get the feedback like, okay, well, I'll just pay higher taxes for the next 2 years, even showing the math, get back to the bank, and then I'll just stay at the bank and go back to, the regular way of doing their accounting. We talked about 67% of people are waiting for that next home and it pops up and then we're going to be in the same predicament again. So what I found from self-employed borrowers is they're almost like looking at these lenders like RFA Alternative as a forever home.
Yes.
Which is very different than what it was, say, pre-stress test or shortly after stress test. Have you noticed that?
Absolutely. So I will even go, maybe not quite 5 years, but my previous life at the previous lender, Optimum, I was surveying a lot of my clients and asking, what do you think of a longer term on the alt side? And I would say maybe 50% were, no, it'll never work because it's only a short-term solution. And the other ones that did a lot of BFS said, absolutely, you guys should be bringing in a 5-year.
Totally.
And we did bring in a 4-year at Optimum at the time. And that is, for me, on my list as well. I want to go longer term because a BFS client is probably always going to be a BFS client. They are not going to try and rehabilitate from a 500 beacon to a 600 beacon. Theirs is a write-off, saving on the taxes, etc. solution. And so to your point, if I can get a 3-year term or a 4-year term or a 5-year term, if the market dictates because we see good rates low now, why wouldn't I?
Thank you for tuning in. If you found value in this show, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, and YouTube. Your support is incredibly appreciated. We also welcome your reviews and feedback, which are crucial in helping us deliver outstanding educational content. Feel free to share your thoughts. A 5-star review would be fantastic if you think we earned it. Lastly, a vital announcement about Backpack Buddies, our chosen charity for 2025. This remarkable organization addresses a hidden hunger issue many are unaware of in British Columbia. While school districts provide meals during school hours, numerous children face food scarcity at home, particularly during the weekends. Backpack Buddies steps in to support these vulnerable children, ensuring they have easy to prepare, familiar food for weekends. This is achieved through collaborations with schools and an extensive distribution network. Your contribution can make a significant difference. With just $20, you can give a child in need a food bag from Backpack Buddies filled with enough meals and snacks to sustain them over the weekend and more. Once again, thank you for listening and see you on the next one.